ETFs and index funds sound too good to be true. As Warren Buffett said, these funds allow a beginning investor to get better results than most investment professionals. So where's the catch? Well, over my 18 years of professional investing experience, having invested hundreds of millions of euros in ETFs and index funds, I've heard all the arguments against these funds. In this video, I will look at them one by one and see which ones make sense. Argument number one. Index funds and ETFs are dangerous. Alright, so 9 years ago, I co-founded a company called Indexo. We were the first to bring index funds and ETFs to our country, Latvia. Our competitors, major Scandinavian banks with decades of experience, went on TV and said this: "Index funds are dangerous. They are great when the market goes up, but when the market goes down, you lose money. That's why you need our actively managed funds, because we can avoid market crashes." This is one of the most popular arguments that money managers use to justify their fees. And it sounds fantastic, right? I mean, everybody wants to invest in the stock market, only get the benefits, and never see the portfolio crash. But the problem is, this does not work. I've experienced this myself. Just look at this chart. The line at the top was Indexo, our index-based investment fund. The other lines were all the competitors with decades of experience and professional experts trying to avoid market crashes. As you will notice, every single time that the market went down, all our competitors went down as well. In fact, they sometimes went down more than our index and ETF portfolio. There's been plenty of research comparing the results of index funds and actively managed funds in down markets, meaning in periods when the stock market falls. And the results have been mixed at best. Actively managed funds do not show any special ability to avoid market crashes. They do not do significantly better than index funds and ETFs when times get tough. And when you look at long-term periods, which include both good and bad markets, index funds and ETFs get far better results. So, in short, this first argument that index funds are more dangerous compared to actively managed funds is false. Second argument, index funds get you average results, and that is a bad thing. Look, it's absolutely true that if you buy an S&P 500 ETF, you will get the average result of the S&P 500. And most people don't want to be average. But the problem is, this argument is actually a rhetorical trick. Yes, ETFs and index funds give you the average result of the market, but they don't give you the result of the average investor in the market. In fact, ETFs get you a result that is much better than the result of the average investor. For example, the Morningstar Active Passive Barometer compared the performance of index funds with the performance of actively managed funds run by professionals who try to find the best stocks to buy. Over the past 20 years in the US large cap stock market, index funds and ETFs got better results than 90% of those professionals. 90%. This happens because the average stock market investor underperforms the average result of the stock market. And there are two big reasons for this underperformance. The first reason is cost. If you give your money to a professional investor, you will pay a hefty fee for their services. Even if you don't do that, even if you pick stocks on your own, you will also pay various brokerage fees as well as bid-ask spreads. But the second, more powerful reason for this underperformance is something called skewness. Here's the idea. Let's say the S&P 500 does 10% per year for 10 years. If it were true that the average stock in the S&P 500 also did 10% per year, then stock picking would be pretty easy. You could just pick a few stocks at random and you would probably get a good result. But in fact, if you pick a random stock out of the S&P 500, chances are the results will be much lower than 10% per year. S&P 500 stock returns are highly skewed. Okay? The majority of stocks underperform the market average. And then there's a small handful of stocks which wildly outperform the market average. They pull up the whole market. Now, the problem is, guessing these winning stocks ahead of time is extremely difficult. So the average investor who tries stock picking, whether an amateur or a professional, mostly picks the wrong stocks, and they get a worse result than the market average. So this is why the second argument that ETFs and index funds get you average results and this is bad is false. If you can get market average results for your portfolio, you are doing very, very well. You are doing better than most investors out there. Now, real quick, if you live in Europe and want to grow your wealth through ETF and index investing, you will probably have a lot of questions like, what are the best ETFs to buy? Or which investment app do I use? And how do I handle taxes? If that sounds familiar, you will love the step-by-step training I've put together for ETF investors in Europe. Just click the first link in the description to watch that video. But here's the third argument. With an ETF or index funds, you will never go to the moon. You will never get what Peter Lynch famously called a 10-bagger, where you put in 10,000 euros and just a few years later you've got 100,000. Assuming you earn market average returns, it will probably take you at least 5 to 10 years just to double your money, let alone multiply it by 10. Now, this argument, strictly speaking, is true. But the question is going to the moon actually a realistic goal for investors? To earn huge profits, you can't afford to buy a diversified portfolio of hundreds of different stocks. You can't play it safe. You need to bet big on the next Nvidia, the next Google, the next Amazon before they become famous. But you have to remember skewness. Most stocks in the market don't do well. It is just a tiny handful that is responsible for most of the wealth that is created. In fact, over the past 90 years in the US market, just 83 stocks out of 26,000 created half of all shareholder wealth. That's 83 out of 26,000. And you have to discover these very few winning stocks before thousands of professionals who spend all their lives analyzing stocks. So, just how likely do you think that this is going to happen? When it comes to making money, I prefer to only play games where the expected result is strongly positive. For example, if I spend a few thousand hours on my business or job, I will make a lot of money. But if I spend a few thousand hours on stock picking, the likely outcome is that I will underperform the market. So I don't see this as very attractive. That said, this third argument, that ETFs and index funds will not take you to the moon, they will not make you rich quickly, is technically speaking correct. Now, the fourth argument. Index funds and ETFs break the stock market. Here's the idea. The stock market only works because you've got millions of individual investors analyzing each stock and making a decision to buy or sell. Supply and demand interacts to set a fair price for every stock. Now, if everybody just buys ETFs and invests on autopilot, nobody's going to be looking at these individual stocks, and there's not going to be anybody to set fair prices. Now, this is, on the face of it, true. The stock market does need some active investors to analyze individual stocks. But there are also massive problems with this argument, starting with the words, if everybody just buys ETFs. By human nature, everybody never does the same thing at the same time. As a practical matter, you will always have financial experts who see opportunities in active investing. And there will be plenty of regular people who want to try their luck with active strategies. For example, right now, actively managed ETFs are a fast-growing part of the overall ETF market. Data as of the end of 2023 showed that in America, only around 18% of the total stock market was held by passive funds, such as index funds and ETFs. So we are still far from ETFs dominating the whole market. That said, yes, passive investing is a strong, powerful trend globally, and it may be having some effects on the stock market already. A few studies have suggested that increased fund investing has led to more stock co-movements, meaning that different stocks move up and down at the same time, and also to individual stocks reflecting market news more slowly. But results have been mixed. Other studies, such as this one, suggest that even as more money flowed into index funds and ETFs, overall, the stock market remains quite active and stock price quality hasn't notably decreased. This July 2025 report, prepared by a team at the University of Bristol for the UK financial regulator FCA, concluded that while passive investing is linked to heightened volatility, its precise influence on market efficiency remains an open question. In other words, there's no strong evidence that ETF and index investing is breaking the stock market as a whole. And when you think about it, that makes sense. I mean, Active investing only improves the quality of stock prices if those active investors know what they're doing. It doesn't help to have millions of active stock pickers who don't know how to read a balance sheet or cash flow statement. If anything, as we saw with the GME saga or the Bed Bath & Beyond cult, too much retail stock picking can damage the quality of stock pricing. I would also argue that this holds true for most small-time money managers at your local bank or financial firm. I have worked in this industry for many years, and it's very rare to find people who have both the skill and the available free time to properly analyze a lot of individual stocks. There's always going to be room in the market for the big hedge funds of the world who hire the smartest people and devote long hours to doing stock research. Managers who are good at analyzing stocks will get results and attract a lot of money from wealthy clients. The active management industry will not disappear, but the less skilled active managers will get pushed out, and this can actually have a positive impact on market quality. For example, this paper from Professor Da Huang at Northeastern University suggests exactly this. The rise of passive investing is making the active fund industry more skilled by pushing out underperforming funds. And, to quote the abstract, since unskilled active managers introduce noise into stock prices, accelerating their exit improves market efficiency. To sum up my personal view, yes, if everybody goes 100% into index funds and ETFs, that would break the stock market, but that is very, very unlikely to happen. So for this fourth argument that ETFs and index funds break the stock market, I'm going to say this is mostly false, with an asterisk, at least for now. By the way, there's also a practical problem with this argument. Even if index funds and ETFs do break the stock market, at least a little bit, what are you going to do about it? Are you going to sacrifice your free time and spend 40 hours a week stock picking, knowing that your expected result is worse than if you buy an index fund or ETF? Are you going to pay a big fee to your local fund manager just because you want to support good stock pricing, even though you know that your expected result is worse? I'm guessing not. All right, but here's argument number 5. ETFs and index funds are creating a bubble. The idea is that if everybody's going to buy ETFs and index funds no matter what, then this is going to push up the whole market even when stock prices should not be going up. Now, there are 2 layers to this argument. The first layer is that ETFs and index funds are pushing up the whole market. And to me, this makes no sense. What pushes up the whole stock market is more cash flowing into the market. If people around the world decide that they want to be stock investors, this can result in higher stock prices. But there are many different ways people can invest in stocks. Yes, they can use index funds and ETFs, but they can also use traditional mutual funds, they can do stock picking, and in any of those cases, the same amount of money would flow into the market, and it would push up the market just as much. So this is not really the fault of ETFs and index funds specifically. This is just about more people coming into the market and making stocks more expensive. Now, there's a second layer to this argument, which is that ETFs and index funds can cause a bubble in the most valuable companies in the economy. For example, whenever you put $100 into a S&P 500 ETF, the biggest part of your money will get invested into the biggest companies. Today, around $7.50 would go into Nvidia, $6.50 into Microsoft, $6 into Apple, and so forth. Even if there are potentially more promising investments in the S&P 500, passive investors automatically invest in the bigger companies. Now, the concentration in the S&P 500 is indeed concerning. Back in 2005, the top 20 stocks in the S&P 500 reflected 29% of the index by market cap. Today, it's almost 49%. But is this actually the fault of index funds and ETFs? Think about this. In 2005, only 4 out of the top 20 were technology stocks. In 2025, that number is 10 out of 20. In fact, tech stocks make up 32% of the whole index by size. So the real question is, do we have a tech bubble in the S&P 500? And the answer is maybe. Today, tech stocks earn 23% of all net profits for the S&P 500, and these profits have grown very, very fast over the years. Arguably, the huge boom in the value of tech stocks has a lot more to do with the tremendous success of these tech companies than it has to do with ETFs and index funds. This is what investment firm GMO found when it looked into the topic. To quote their findings, the primary driver of the enormous market caps of the Magnificent Seven is, drumroll, the enormity of their earnings per share growth. From an investing theory perspective, Index and ETF investing should not create bubbles. ETFs and index funds invest in all stocks in the market in proportion to their current market size. In doing so, ETFs and index funds should not distort the relative size of different stocks. What they can arguably do is boost the price of stocks which are included in a popular index versus those that are left out. For example, large cap S&P 500 stocks may be more expensive than small cap US stocks, in part because everybody buys the S&P 500. So this can be a good reason to also include small cap stocks and global stocks in your portfolio instead of just putting everything into big US companies. This is a point that I've raised before in my channel. That said, at the end of the day, no, index funds and ETFs do not create bubbles. So I will judge this fifth argument as false. To me, index funds and ETFs are a total no-brainer for most people. The only tricky part here in Europe is getting started because we've got thousands of different index funds and ETFs available, and the best fund to choose depends on the country in which you live. To find out how to make the best possible choice, watch this video next.